Good morning, good afternoon, good evening, wherever you are. This is Playbook of the Wealthy. My name is Dave Grant. My co-host is Heather Townsend. Thank you for joining us for another episode. Today, we're taking all your questions. If you have a question, too late. We've already gathered them all. Sorry. So, before we move on, if you can pause this show, follow the show if you're on a podcast app, subscribe if you're on YouTube, like it, comment, spam it, rip it, send it across the world. I don't care what you do. We need to get more exposure because everyone needs to hear this information. So thank you. If this is your first time here, our podcast is split into 3 sections, 4 sections maybe. You get to know about each of us personally and professionally. We dive into content, we answer questions. Of course, it's going to be a little different today because we're doing all questions. Before we go any further, we are a financial services podcast, so we do have a disclaimer. You haven't met this gentleman yet. His name is Jordan, and here's the disclaimer.
All opinions expressed by Dave Grant and Heather Townsend are solely their own opinions and do not reflect the views of their respective wealth management firms. This podcast is for informational purposes only and should not be relied upon for investment decisions. Nothing in this material constitutes a solicitation for the sale or purchase of any securities. Clients of Retirement Matters and Townsend Financial may maintain positions in the securities discussed in this podcast.
What did you think of the disclaimer, Heather?
He beat us. I think he beat us.
I think he's a pro at disclaimers. I think we have lost our jobs forever. So I'm not too sad, honestly. All right. The last 10 episodes, I've asked Heather how she's doing in a way that I slowly realized became a pickup line off a TV show by Friends and Joey Tribbiani. So we're changing that language. And now I'm just going to ask her, you good? Because that's what we do. So Heather, you good?
I'm good, but I have a story I want to share today. Yeah, just hold on. The energy's going to go down for a minute. I'll bring it up. But, you know, one of the reasons I am doing this podcast is to share knowledge, right? That's one. And I think people learn the best from stories. So I'm going to tell a story of what has happened to me this week. I got a call. It was in the middle of the week. And it was a call that no advisor wants to get. It's from a client and they're in the hospital. Now, some information on this client to give is we've been in the process of switching their health insurance because when I ask them for their health insurance, I don't sell health insurance, but I've seen enough to know when it doesn't seem right. And I go, I don't think you're adequately covered. I don't think this is real health insurance. And so my client was in the process of getting proper health insurance, but they openly were putting it off, right? Because life gets busy. And so now they're in the hospital and they don't have the adequate health insurance. And registration is saying we need $5,000 now because your health insurance only covers a few thousand a day and your hospital bill is already at $8,000 while we're running tests.
Jeez.
And, you know, we're still in it right now. The client is out of the hospital, thank gosh. They didn't have to get surgery, which was what I was the most concerned about. So it's going to be a bill that we luckily can financially handle. But it's money that they shouldn't have had to spend, right? And we'll see how this goes out because until with this certain health insurance, which people listening, I'm putting in quotes, you know, you have to have a diagnosis before they can technically cover you. And so we got to see what the diagnosis is. But why I'm sharing this story is imagine you're sick, which when you're not feeling well and you don't know what's wrong, that is, no one likes being in that position. You're not in a good place, right? And do you want to have the stress too of, oh my gosh, this is also going to cost me and my family an amount of money that could not stop and have that anxiety? No. You're like, thanks, Heather, for bringing down the energy.
You got to return the question because I have an epic answer.
How you doing?
No.
I'm not. No, I'm not allowed. Oh, you good? You good?
Do you know what I did this week? I found new sound effects so I could bleep out words. and then I can put my hand in front of my mouth so you can't lip read.
It's been a week,
Worst
hasn't
week
it?
of my career in a long time. Multiple things. You know when one thing goes bad and you're like, thank goodness it just was that bad. The rest is going to get better. No, it got worse. So we're moving on. And I'll tell you at the end of the podcast how I got over that really bad week, because last night I was over it. And it
Oh,
involved sports. Let's dive in. So, Heather, kick us off.
okay. I recently filed my tax returns and got a $4,800 tax refund. What should I do? Dave, what should I do?
Go to the bank, get single dollar bills, and play Scrooge McDuck. I would love to do that just one time.
You've said that. I think we're going to do it. That's maybe on our 100th episode. Let's just do it. I'm putting that out there. We're going to do it. There we go. Let's do it. It'll be fun. All right. Keep going.
All right. So $4,800, that's a bunch of change. So every month, that's $400 in your paycheck you are not getting. So change your withholding to get $400 back in your paycheck, back into your bank account each month. And then you can start doing some stuff with it, assuming your pay is staying the same year to year. But I personally don't like that people take their tax refund and it all goes one place. I like when people get a windfall like that, take a little portion of it. So I say like 10%. So take $500, go blow it, go have some fun. Because that's what money's for and part of it. But then kind of follow the strategy of, okay, if you got outstanding consumer debt, pay it down. If that $4,800 minus the fund money pays it off, then you move on to savings. Let's beef that up. If that's all it can be, invest for the long term. If you're already doing that, start paying down your mortgage. It just kind of follows that same track of being financially responsible. When you get that windfall, you just follow the same strategy again and again.
You know, for me, it's like my asset accumulators. So not in financial freedom yet. If we've achieved our financial savings metrics, then sometimes they like to take 50% of that and save it so that they're ahead for this year.
Mm-hmm.
And then we apply it to one big goal. I feel like when you have windfalls or money unexpected, then it's way easier to achieve a bigger goal than like, $400 a month. Yip-de-doo-dah. That's like, oh, now you can go get that new, I don't know, barbecue or mountain bike or whatever these things my clients spend their money on.
You haven't bought a barbecue or a mountain bike recently, have you?
I know. I think mountain bikes are now like $9,000. No, but $5,000 is.
Okay. I thought you were talking about the monthly. Okay.
No. Monthly. I like monthly for my asset accumulators many times just going into investment accounts because it's like a bill, but not when you get a windfall like that. If they've already met or if they've been above and beyond with their metrics and they're waiting on doing a goal, I'm like, just go do your fun thing. Go do it. Retirees, though, this year, I'm applying the refunds to Q1.
Okay.
Just so we don't have to pull more out of the market right now.
Why? What's going on with the market? It's great.
Oh, it's just bebopping along.
Question number 2. My son has done pretty well saving for college. He has about $20,000 in savings and $10,000 in checking. He'd like to move the $20,000 into an investment account, and I was wondering what you would suggest.
So this was actually a question from one of my clients. Incredible. So I said, go him. Way to go. Like in college and wants to invest $20K in college. I was lucky to max out my Roth IRA when I was working for an internship in college, which was at that time, I think $5,000. So, whoa. Mm-hmm. So I recommended, a robo-advisor. That is not someone who needs a financial advisor at this time, right? So go robo-advisor. Mm-hmm. I sent them Wealthfront. Betterment is another option. Vanguard. And I said, set up a regular taxable brokerage account. I did not know if this son, though, had earnings. So I said, if your son has earnings, meaning W-2 or 1099 income, they're going to file a tax return. Do a Roth IRA. And they can still do the 2024 Roth IRA if they had earnings in 2024. So do 7 for 2024, 7 for 2025 if you already have 7,000 of earnings in 2025, and then put the rest in brokerage. So that's 6. Woo! That's what I said.
Nice.
Client was happy. I got 2 thank you emails.
Man. So you didn't say go and invest in crypto because you're younger, because that's apparently what all young people are doing.
I wonder in 20 years where crypto will be. Even 10.
Yeah.
I'm just going to say
It'll
that.
be interesting.
Do you remember NFTs? Where did those go? Where? Hello? Okay.
Yeah.
Okay. One of my clients sold a house to move to a different house that is, after doing their life planning, way more aligned with their life goals. They are closer to family. This house it just has all the things that they imagine when they're in retirement, or just a house they want to be in right now. They're in their 50s, both still working. And we are working really hard to catch them up for retirement right now. Okay. And they have an extra $80K from the proceeds of the house they sold before they buy their new one. It's being built right now. So their mortgage is about 6%, going to be about 6% on the new house. It's a new build, so there's different options. And they have a lot of money in 401ks and IRAs, but nothing really in brokerage. Would you take that $80K and put it in the mortgage to reduce their payment? Of course, I've done the numbers, so I'll let you know it's about $400 a month that will reduce their mortgage payment. Or would you put it in the brokerage? Go, Dave.
$400 reduction is a lot more than I was thinking if you throw $80K at it. Just because I'm in a similar situation, recalculating mortgage stuff. I am not throwing it at the mortgage. I am keeping liquid. I'd probably keep it in savings for now, let the whole thing play out, see where we're at, and then ultimately invest it.
That is what we determined.
Yes! Let's go!
Yes. I will say, I said the same thing because I was like, let's just let this play out. So many things can happen. But they're like, no, we want to throw 15 in the market. You've taught us too well. It's down. I want to buy at a discount. I was like, I can't argue with that. So we're taking some, throwing it in the market, and then the rest will go to their brokerage. But we did the math, and making up like $400 in mortgage savings, it took, oh God, I might say it was some massive amount of years, 10, 11 maybe. I don't remember exactly, but it was like, no, I'd much rather have that liquid. Okay.
All right, let's talk about babies. So my wife and I have a newborn son. Thank you for the sound effects. I want to start saving for college now, and she thinks that college might change in the future, so saving for it isn't a priority. What do you think?
It could change in the future. I don't think either one is right or wrong in this. And I think it's one of those where a balanced approach wins. And that's normal. I don't believe in overfunding 529s. I've said this over and over again. But there's other options. And there is tax drag on a portfolio and a brokerage. I mean, you and I try to limit it as much as possible with ETFs and all of that. And I won't go down that, rabbit hole. But, put some in 529 because you have the options of, hey, K through 12, you can still pull out $10,000 a year, penalty-free, tax-free for tuition. So that's always an option. And, with the Secure Act 2.0, if you have money left over, you can transfer $35,000 to a Roth IRA for your kids. So, and I think the question I would ask too is, are they going to have other kids? Because, I have that discussion with my clients. It's like, okay, well, maybe one won't go to school. I see that a lot, but the other will. And school always ends up being more expensive than expected, right? So you just then move the 529. So I would do some, but not all. I definitely in the software would lower it to not be on track 100% to pay for college, maybe like 50%. That's normally what I do.
Sure. This is an interesting one though, because in my eyes, this question was going more to the philosophy of saving for college. And I know a lot of people have different thoughts on it of, I'm not going to save for my kids' college because I never had savings for it. I had to pay my own way through. And I took loans and I paid them off. So I'm going to send my kids the same way in. Whereas I think if you're split on it as a couple, you can save for your kids' college and not use a 529 plan. You can just use a regular investment account and earmark it as, okay, this could be potential future college money. Let's figure out our feelings about it later on. And if we decide that they're going to take loans all the way through, it's investments in our name and it's not earmarked for college legally. So we can now use it for whatever we want to. Is there as many tax advantages? No, but that's fine. Like you're still agreeing with your spouse at that point. You're just saving. And if things change in the future, you get to spend it on what you'd like.
All right. I am 62 and retiring in 3 years. What are the best ways to save for this retirement? Come on, retirement matters. Dave.
I was saying, how long do we have? I could go on forever.
I know you could.
So I think when you're looking at retirement, you got to think about balance. So you got 3 different types of accounts you can save to. You got your tax deferred, so your 401k, your taxable, which is your regular investment account, and your Roth. So your Roth IRA or Roth 401k. Ideally, you would have a balance between all 3 when you hit that retirement stage in 3 years. How many people have that perfect? I'm going to say 1%, because there's always that someone. But I don't see anyone who has this perfectly aligned. So if you're not aligned, now is the time to shift. You got 3 years to do it. So I think if you're using a 401k and you need that tax break because your income is quite high, you are now in that new sweet spot as of changing rules where you get a bigger catch-up amount than someone who's 58. It's quite bizarre between the ages of 61 and 63, but take it and run with it. So you got the regular 401k contribution and you can do an additional $11,250 in 2025. If that is going to lopside your portfolio by doing that amount, then you need to cut back on that and not max it out and go to the Roth and the taxable accounts. What ideally I would like to see you have when you get to 65 and you're retired is to have 1 to 2 years in cash of living expenses. Because that now gives you that cushion of what are we going to do tax-wise? I can start to take money out of the 401k and IRAs and start to trigger taxes. But if I don't need to, I've got the cash that I can use. Then I would probably say the last thing is going to be your asset allocation. You may decide that it's a little aggressive right now, and as you're getting ready for that transition, you may want to start to get a little bit more conservative. Or if you're comfortable and you're not seeing as, that transition is going to affect your investment choices, then you may be okay. But definitely take a look at, how much risk do I want to take? If I change my allocation, does it affect, my success in retirement? That's going to be a wet finger in the air thing for you to kind of gauge.
And do they have enough? I think a lot of people think they can retire sometimes and then they don't have enough. I have gotten questions from clients, 2 of them, about should I do an all-in-one mortgage? What's an all-in-one mortgage?
All right. So your regular mortgage, let's say you got a 30-year, you're getting a fixed rate and you pay it off over 30 years. An all-in-one mortgage is a HELOC. HELOC has a variable interest rate depending on what it's doing. You essentially get your mortgage as a HELOC. You have a checking account alongside it. Your paycheck goes into the HELOC and you pull money out to live on. The rest of your paycheck that you don't spend pays down the mortgage balance. Essentially, it's trying to pay down your mortgage quicker by doing automated savings.
And that's how they market it completely. Faster pay down, which this is so well targeted to people that can't stand debt, right? And that want to pay off their mortgage. One of my clients, when we ran it, their mortgage was already at 3%. So in no way would that make sense in that regard, right?
Yeah, HELOC rates are high.
Right. They're 7 or 8 right now, I think, maybe 9. So definitely math-wise didn't make sense. Then you just pay off principal faster. But, it's interesting. I get the idea of it. If it works well. But let's play out if interest rates go up more and you could get yourself in a really bad financial position on interest. I mean, there were times in the 80s that mortgage rates went up to 18%. And like, no, I'm not saying that I think that that's going to happen. I, again, don't have a crystal ball, but the risk is too big, in my opinion. I think if maybe you had $100,000 of loan and, you know, $1 million in a brokerage account, okay, I'm not so concerned. We could deal with it if that. But if you don't have a lot of liquidity on the outside and a large mortgage and it's going to take you a while to pay that thing down, no. That's no way.
I'll give you the controversial take. I think it's for lazy people. I think it's for people who can't control their spending. Because you're essentially trading a lower mortgage rate for an adjustable rate HELOC. And the other way around you could do is have a 30-year fixed rate and take the excess savings that you have each month and just pay it to the principal, which is essentially the same thing you're doing, but the mortgage company's doing it for you, charging you a higher interest rate. So I'm like, well, if you knew what your spending was and you could control it, you can do this all yourself.
Completely agree. So both answers are no, is what I am hearing. Yeah, we're like, no.
Yeah. Come at me, mortgage brokers. Let's do this.
I don't know how many sell them, though. I haven't heard, my clients haven't heard of this from mortgage brokers, interestingly enough.
I have a good friend who's an advisor who got one and told me how great it was. And I looked him in the face. I was like, are you crazy? Like, what did you fall for? And he's like, my income can sustain this. And my wife really wants to pay this down in the easiest way possible. And that's what we're going to do.
Oh my gosh.
Okay.
I wonder how much extra interest they're going to pay in the life of this loan.
Yeah.
Okay. All right. Do we have time for one more?
Time check. Let's do one.
Okay. My mom is 87 and her health is failing. By the way, Dave cut it out, but I said falling at first. Okay. Failing. She has a net worth of $15 million, and we're aware that may pose some estate tax complications should she pass. What should we be looking out for?
Alrighty. Let's give you some context. So a single person has a estate tax exemption in 2025 of $13,990,000. So that is lower than $15 million. What will happen is anything over that is subject to estate tax. But we are due for a sunset of those rules at the end of 2025. There's no guarantee of what it will drop to, but projections are going to be that exemption drops to $7 million. So now Mom 87 is going to have $8 million of her estate be subject to estate tax. So what should they do? Contact a lawyer. You can write legal documents for your estate that will be able to bypass this in some way. Estate planning attorneys are really good because they can design different trusts. They can design wording that will accomplish things this year. And if law changes, you don't need to change all the documents again. It's written in a way that will allow for that change. Estate tax is not a bad thing, though. Like, yes, you have to pay some money, but you're still going to end up with a sizable inheritance. If you do want to avoid the bill, though, you want to have liquid assets in this. Well, if you want to be able to pay the bill, you got to have liquid assets in this estate. So if the whole estate is real estate, you might want to consider selling something in order to get some liquid assets to pay the bill, because you have to pay it. You have to sell the real estate anyway. The old way to do this is life insurance. Yeah. So if you got life insurance on Mom, that would pay out at her death and that would pay the estate tax. But if health is failing, that's not going to be an option. The last thing, if you start giving assets away, there is a clawback rule. So I believe it's 3 years, that anything that's been gifted 3 years before the date of death can be pulled back into grandma's estate and still assessed for the estate tax rule. Don't quote me on that. Get an attorney.
But that doesn't count to the estate tax exemption, does it? The 18, I think it's 19,000 this year. Do you know if that qualifies?
Oh, the gift tax? No. But if you're just starting to gift assets away, like if I'm going to give you a house, it's not in my name anymore. I'm just going to retitle it to you.
Yeah. Because I'm like, start gifting at least that 19,000 right now this year, right? That you can to the people so that's out of your estate. The other thing that's interesting right now, I thought, is I was like, assets are depressed right now. So there's got to be, this is a great time to be getting them in those irrevocable trusts, I'm sure. I mean, get with that estate planning attorney right now. There's so many clever things. I was at this conference, and this is when I hired this estate tax attorney because I heard him speak, and I was like, that's the one I want for my clients. And he was talking about how there's a crafty way of you value businesses and assets at a certain time, and you create the valuation. I mean, of course, there are ways. We're going to leave it at that. There are ways.
Not saying anything else for legal reasons.
Yeah, I am not a lawyer. Consult with the lawyer, but there are ways.
We're going to move into highlights. This is our personal section of the podcast where you get to hear about our highlights or personal wins of the week. I'm going to go first. So I told you at the start of the episode, this was one of the worst weeks professionally I've had in a long, long time. The way I got through that is I had a friend's birthday party 2 days ago. We played pickleball. None of them could play. I've played for a few years, so I spanked them. I then went back for my pickleball league the next day, and the pro who leads the league told me I had the shot of the night. Let me set it up for you. And this just resolved all my week. There's a shot in pickleball called a third shot drop, which is essentially the third shot of the rally, and you play it from the back of the court and you hit it in such a way that it just gets over the net and it drops on that side and they can't hit it back. So me and my partner were stood in the middle of the court. She's an older lady, so she's not going to be able to move as fast. The opposing team lobs the ball over her head. I scramble across the court. I hit it while I'm running. It's a third shot drop. It just drops over the net. The other players can't reach it, and I'm still running across the court. That felt so good. I yelled. Everyone looked to see what was going on because I thought I was hurt. But once they realized that I just won a point, they were like, shut up, Dave. And I just kept playing. Ultimately, lost that match, but that's not the point.
You feel better. You went back to pickleball.
Pickleball for the win this week. Yeah. All right. Your highlight.
My highlight is just, it's sweet. It includes you, actually. I had a tough week too. And, this is a relatively male-dominated business. Let's say it, right? And I just feel so lucky because I call them that I have male advocates. I think they're entirely necessary. And you called me, the CPA called me, my other guy friend advisor called me, and we're just getting me straight. You got this. You're awesome. And, it's just so nice to have friends in this business when you have stuff going on with clients and personally and all of that. And just a good reminder. Yeah, no, keep going.
When we tell those stories to our industry friends versus our non-industry friends, the industry friends will commiserate and then say, okay, get back on the horse. Go run your business because it will fail if you're not there. And let's go. Keep going. Friends outside don't quite get it the same way.
So that's where I'm ending.
We do keep it real.
You did and I need that. Because I have some masculine energy as a female. Let's say it. I love cars. I have male friends. There's a reason for it. And I'm in a male dominated industry. And the other industry I was in is construction, another male dominated industry. A little fascinating, right? Okay. But anyway, I'm just going to end on, I'm really grateful that I have female and male friends. And there are times when I need the male friends more than the female friends. And that's just reality.
Sure. Completely agree with that.
Yeah, sometimes I'm not calling my male friends either.
On that note, which meant that Heather's not going to call me for the rest of the week. Thank you for listening to this episode of Playbook of the Wealthy. You can find us on whichever platform you listen to podcasts. And the video version is on YouTube, Instagram, and LinkedIn. If you want to email the show, Heather wants to hear from you. Contact us at hello@playbookotw.com. And we'll see you next time.
Toodles!